So I'll start off by saying I'm Dan Rosenstein. I work here in Building 25 at Microsoft. James and the Fresh folks and Kurt reached out and said, "Can Microsoft host the event?" And we were like, "Yeah, we'd love to." And so here you guys are. This space is actually an interesting space. It's been around like this for about 22 years, where we brought partners and customers in to do co-engineering and co-partnering work. In addition to that, over the years, it's moved from one team to another, and our robotics team is now housed here. So you're actually in the center of where all number of the people that you see around are working on robotics in one way or another. And then I guess the only other two things to say is I happened to start at Microsoft 25 years ago in this building, which is kind of crazy. And this facility was all set up originally so MSNBC could do their broadcasting out of here. So as you walk around, you'll see a lot of open spaces. You'll see some satellites on the roof. The infrastructure of the building was built that way. And if you happen to be in the garage as well, you'll see some of the old MSNBC infrastructure. So welcome to the Northwest Robotics Alliance meeting. I'll hand it off to Firdaus. Did I get that right, or did I butcher it? So,
right, can everybody hear me okay? Fantastic. Well, thanks for joining us. I'm Firdaus Pohowalla, Managing Director at Cascadia Capital and lead our efforts in robotics, automation, and AI. Along with Madrona and our partners at Fresh, we founded this idea of the NWRA, the Northwest Robotics Alliance, earlier this year, because we felt that there was a need, right, to have this kind of a forum for all of our ecosystem partners here in the Northwest. There's always been a very strong tradition of hard tech in the Northwest. And as the community has evolved and as the technologies evolved, we felt that there was a greater need to create ecosystem connectivity amongst all of you and have it focus primarily on founders and entrepreneurs, but also serve as a resource for everyone as they sought to build businesses in the space. So a trick question for everybody, or pop question. In the ranking of regions, where do you guys think that the Pacific Northwest stands in terms of density of robotics and automation companies? First, second, third? Fourth, okay. Any other ideas? Third? Third, okay, good guesses. That's excellent. Obviously, leading question when I asked that, but it's second when you think about, and we're being a little generous, but when you think about Oregon, Washington, Idaho, and British Columbia. California has about 850 companies, but that Northwest regional group has about 250. So as you think about the connectivity amongst all of you and you think about the opportunity, right, there's density, there's scale, there's strong research and academic institutions, and there's a very robust and vibrant VC community that's developing a greater focus on this category and this technology. So we're starting to see all the effects of what we would call a flywheel, right? All those different actors coming together, everybody spending time with each other. And what makes me really excited and what makes all of us really excited is that there are a lot of repeat faces from the other two events that we had earlier this year. And I think that's important because it speaks to connectivity. And I think it speaks to the value of what we're doing. Our first session in April was focused on really starting this, right? So we talked about some of the topics we're talking about here. We talked about autonomous vehicles, and then we talked about emerging technology. Our last event, which was hosted by our friends at Fresh, was focused on generative AI and some of the applications there, which is an interesting and evolving topic, not something we're going to get into too deeply here. And then today, as we were sitting here, we were thinking about what are the most important trends that would impact founders. We thought about all the different topics that we could have spent time addressing, and there's lots of them. And I think at the end of the panel today, James from Fresh is going to come up and talk about some opportunities to be engaged and what we have planned for the NWRA over the next year or so. But as we thought about what was going on today, the idea of scaling, fundraising, and pitching to fundraise have always been on the minds of founders and entrepreneurs. But today, more than ever, it's become a bigger topic. And why? It's because it's become a lot more challenging, right? The market is starting to crystallize its thinking about robotics as an investment category. And with that has come more discipline. Right? And with that has come more focus, and with that has come more objectivity. And so our goal with this panel and this chat is to really create some more clarity into what that means, right? None of you will leave this room satisfied that you have obtained all of the answers to those questions because they're fluid and they move in line with the market. But the objective is to use all of us, primarily my friends Eric and Aseem, to try and understand and get your questions answered with as much specificity as we can provide. With the objective being that you'll come out of here to the extent that you have an idea that you want to develop and run with, a better sense of how you make that successful. A lot of the things that we'll talk about are I would say maybe difficult to actualize, but if you have an idea of what that target is, then you'll have a better sense about how to go out and get after it. And what I would ask everyone to do here today is to be interactive. We're going to touch on a lot of points. I'll push these guys to go deeper on topics to the extent that makes sense. And when we feel like we're hitting that wall, that's when you guys chime in with the harder questions, right? So we'll get going. We'll start having some conversations, and then I just ask you guys to kind of raise your hands and make this participatory. We've allocated an hour and a half. If we actually get to that, I'll be happy, and hopefully we'll have answered everybody's questions. So thanks for joining us, and we're looking forward to an exciting and informative conversation today. So I'll give you a little bit of background on myself. Cascadia Capital, we're one of the leading investment banks in the country. We have probably the preeminent robotics automation franchise. I spent a lot of time with founders and entrepreneurs focused on capital raising and mergers and acquisition transactions. So nice to see everyone. I'll turn it over to Aseem. Maybe a little introduction on yourself.
Yeah, hi everybody. My name is Aseem Datar. As of Monday, I'm now at Microsoft. Joining them as VP, working on next gen compute, whatever that means, including things like AI compute as well as quantum. That's out in the horizon. Prior to this, I've spent about 2.5 years at Madrona Ventures as a VC. I'm still involved with Madrona and joined their founder network, which is also advising founders who are building great companies in spaces like robotics, automation, true SaaS. And then prior to Madrona, I was 17 years at Microsoft, so it's a little bit of a life comes full circle back for me. Started here at Microsoft in 2003 as a dev, ran a dev team, then built product, go to market, ran a sales team for a while, and then 8 years ago, or my last 8 years at Microsoft, was CEO of the Azure team, incubated that business from millions to a 20 billion P&L. Was lucky enough to sort of work on that business. Rocket ship. Few of my friends I see in the room, who are partners in crime. So excited to be here and excited to talk about lessons I've learned and things I've seen and patterns that generally VCs think about and how we match up. Thank you.
Hi, everybody. I'm Eric Klein. I am a partner at a early stage venture firm called Lemnos. And I spent my first 20 years as an operator, early employee at Microsoft, Apple, Palm down in the Silicon Valley, Real Networks, Sun, Nokia, sort of ran the who's who around that. And about 10 years ago, some of my engineers came up to me and said, hey, you probably have a little more money than I do. And I got sucked into the world of angel investing and now institutional investing. Have done over 100 investments, both across my professional and my personal portfolio. And I think we're up around 28, 29 robotics investments. So have lived the gamut. A lot of our startups that we did our initial investments now are have either been acquired, shut down, or a lot of them are in what I'm going to call sort of what we say in the business sort of BCD, which is the growth stage of capital. So these are multi-hundred companies with robotic systems in production on a worldwide basis.
Great, thank you. So before we get into everything, Aseem, I just want to start with you a little bit. Maybe talk about your journey from Microsoft to Madrona, back to Microsoft, and how that overlays with sort of your exploration of the robotic space.
Yeah, I think teeing off what Eric described, I was an operator for most of my life in my working career at Microsoft. Started as a dev, then PM. Had the opportunity to work on two growth businesses. One was a mature business when I first came in as an intern called Windows, 98% market share. Hard to sort of move the dial. And then towards the later half of my career, worked on this rocket ship called Azure, and we were doubling every year, and that was a phenomenal business. Built about 300 services. We were launching a service a week, and so it was just the pace of innovation was just something that kept drawing me back to building new services within the Azure team. And then I was on the buy side when it comes to acquisitions. Did about 12 acquisitions on the Azure team and the cloud platform team. And got connected to folks at Madrona, started spending more time with them. And, very quickly, like Eric got sucked into being a partner there and, investing on infra all the way into SaaS with a focus on automation and robotics. And then, there's few moments which are transformational. I think we're seeing one such moment right now with the infusion of AI and like big compute sort of driving all the innovation in the ecosystem. And, it just sort of dawned upon me that, it's a great time to build again. And so here I am back at the mothership, kind of, building or try to at least build the next generation of compute.
That's great. So Eric, I've talked in the past about this concept of Gen 1 robotics companies, and now we're sort of into Gen 2 and thinking about Gen 1 over the past 10 years. Maybe spend a little time talking about what's evolved in the market for Gen 1, right? What are some of the things that early founders have experienced and challenges they've faced, and kind of what's happened over the last few years before we've come to 23 and what we're experiencing now in terms of the fundraising environment.
And I use this term sort of Gen 1 robotics, and it's a misnomer because, of course, there were probably, going back to -3, -2, so many generations of robotics. But if you look back in about the, 2000, I'm going to say 12 to 16, sort of, there was a big wave of venture dollars that looked at the labor market. And we all read the news. Across the globe, labor is becoming a critical issue across many professional industries, an acute issue. And venture looked at that and said, well, how are we going to augment that labor? How are we going to replace that labor? And of course, that led to a big explosion of investment in the robotic space, both horizontally, right, looking at, do we create a platform and infrastructure for other robotics companies to build on, and vertical placement of robotics. And again, many dollars. We're talking about billions of dollars in aggregate on a worldwide basis were deployed into robotics in that window. Like any Gen 1, I think we've made tremendous progress. But if you look at the challenges that those companies are facing and in the window that they're in now, out of those, in classic venture fashion, thousands of seeds are sown. Only a certain number will grow up to be trees and plants and wonderful things. And a lot of those companies who have made it to here are now, again, in what we call this growth round phase, where they've got to transition from making snowflake robotics, right, one-offs, right, and from a business perspective, talking about pilots with companies. And the transition is to get to access to the later rounds of capital, you really have to create robots on a thousands basis. You've got to scale up into service and support and do all the right things for the business to grow. And that has proven challenging. I would say, the statistics will show that this generation of robotics companies, definitely there's going to be a high failure rate. But outside of that failure rate, what we can start to look into is this transition of what we're going to call Gen 2, right? Another wave of money, another wave of opportunities. And I think part of what we can impart here is the knowledge of what, maybe some things that Gen 1 didn't know, right, as trailblazers into commercialization of robotics, that Gen 2 founders like yourselves can carry in and have that knowledge as you're starting your companies.
So let me build on that for a second, because you raised an interesting point. In the early days of robotics, right, pre kind of 21, 22, there were billions of dollars that kind of came into the space right? And there's probably less evolved of an understanding of what it took to make a company successful. But that's a significant amount of capital that came into a sector that was unproven. So what was driving some of that, right? Given the fact that we had essentially greenfield, right, in terms of the outcomes of a lot of those businesses.
I mean, in that window, if you were a talented mechatronics engineer coming out of 5 or 10 different schools, you sort of had the ability to walk into a venture capitalist and say, I'm going to automate X, and it's got a robot, and it's just sexy. And off to the races that money went. Where what we had was, and while I'm not trying to trivialize it, what we had was amazing domain expertise in how to theoretically build robots and how to build 1, 2, 3, 4, 5 robots. But the challenge is after a certain amount of time and a certain amount of cycles, venture capital is looking for a business that within 3, 4, 5, 6 years at max hits $100 million roughly of annual reoccurring revenue. And if you're a roboticist out here, you're going, well, I need a certain number of years just to get to robot one, right? But all this time, the venture capital community is continuing to put pressure on these robotics companies to grow at the same rate and speed that an enterprise SaaS company might grow at. And while these, a lot of the founders in Gen 1 were incredibly talented from a technical perspective, one of the biggest challenges they faced was entering vertical markets that maybe they didn't know as much about. Agriculture, right? Heavy mining. Some folks went into homes. Some people went into the hospital market. Across all different vertical domains, we tried to take technology and robotics and apply them in a cost-efficient manner. And what we learned is that's a little harder and it requires a lot more expertise than maybe the founding teams and even the venture capital community completely understood.
So Aseem, maybe you could build on a little bit because you've been sitting in a nice perch at Madrona for the past couple of years studying the space. What's changed in the last 12 months? Right. I think Eric touched on some of it, but maybe we can go a little deeper and talk about why we've seen such a fundamental shift in investors' perspectives on the category.
Yeah. I mean, before we get to that, I did want to add to what you were saying. There is this reality around pattern matching a SaaS-based business model to, sort of the robotics model. And I think there's a wide gap between those two. Right. I mean, if you ask a customer who's sitting over in an enterprise manufacturing company saying, hey, do you want to buy CapEx or OpEx? I don't think that you're going to get a singular answer. I think it depends on the type of customer and what their spending appetite is. So for a robotics company to go to them and say, hey, we'll give you this robot and just buy it and we'll never come back again and we'll sell you a service on top of it, like that's one approach. The other approach is, hey, you rent it from us and then you keep using it and you pay per usage, kind of the ARR type of model. And I think, a lot of, I would say, investors/builders have tried to take the one only approach. And I think my learnings so far in this business have been that I think it's more largely customer driven. I mean, we've seen some customers of our companies or that Madrona invested in kind of choose one over the other. And, you've had a dichotomy, like you'd had an even split across the customer base. So I think there's a fluidity around business model that you need to sort of keep in mind. And then the real question then becomes is, as a company, how do you sort of get to that repeatable phase so that you're not diverging from the existing use case? I think the cone of uncertainty that a robotics company has to solve for is pretty wide. And you can very easily get to the point of like, hey, I'll go build and follow where the money is. And very soon, before you realize, you actually become a services company. And that's sort of the slippery slope of many startups that are trying to achieve that scale, because now you're throwing GTM dollar after dollar and you don't have a repeatable motion, which makes your investors nervous, which in case then puts pressure on you from an exit or from a getting to 100 million ARR standpoint. So I think there's a lot to sort of unpack there from a hey, what's the difference in Gen 1, Gen 2 perspective?
Okay. But just I want to really kind of drill down, right, as we think about investors, because we'll talk to, on our end, 30, 40 robotics companies a month, right? And 95% of them are asking us to help go out with a capital raise. And as we go out in the market and talk to investors, we've just noticed a sea change in attitude, questions, skepticism, desire to deploy dollars, right? And so has there been a fundamental trigger around that? Has it just been kind of a maturity and realization of how hard this is? Like, to Eric's point, what do you guys think about that?
I think there is certainly a realization from investors as well, right? As to the fact that, hey, look, as we come back to the business model point, like you need to be open-minded about what the business model for a particular robotics company can be. And I'll give you an example, right? When you start to go build something, oftentimes most robotics companies who are not pure software only, have two distinct mechanisms or metrics that they look at: billings and bookings. And I think, often one lags the other. And when you've actually got, bookings, but you've actually not converted them into deployments, when you go to deploy the units, you realize that, oh my God, my unit economic cost is actually 10x as to then what I planned for. Because now your unit is in the market. Now you're starting to bear support costs. Now you're starting to do services. Now you've got to do like updates, et cetera, and the whole 9 yards. And maybe your supply chain sort of gotten expensive because the trade laws have changed, or excise is more, and whatever. And you really don't get to that unit economic equation that an investor is looking for in the SaaS business. And frankly, I think the investors are getting educated as well to say, until you get to scale, whether it's 10, 50, 30 units or 100 units, you truly don't know what your unit economic is going to look like. And so I think that's something that's been educative for the entire sector, as to how do you get to that predictable base.
Yeah, and I think you're going to hear this for the next 70 or 80 minutes, whatever time we have left. The interesting thing about the state of robotics right now is it's less about the technology, amazing technology things going on right now. It is really about the transition for robotics to become commercial partners in business and the capital efficiency of doing that, right? The premise that Gen 1 roboticists and VCs bought into is they look at a particular labor market and they say, hey, a commercial welder makes $150,000 all in a year. And in the United States today, there's a gap deficiency of 400,000 folks. So we need 400,000 new employees. We're going to use robotics to deal with that. And the robotics teams came in and said, well, heck, I think we could build a robot that does that. And the interesting thing is when you factor in switching costs, which is, literally moving processes and people from one thing to another, you really have to change the net economics. If that employee makes $150,000 all in, to really have an effective switching cost, your robotic solution needs to be at maybe half that cost. And the challenge has been from an economics perspective that on a fully burdened basis, a robotics company trying to replace that human, we thought we could do it far more effectively from a cash perspective than we actually can. And so to answer this question, I think the more educated venture capitalist today is looking at things like, and I think this is sort of the lead in, they're looking for experienced teams that understand how to sell product into a market out of the founding team. Number two, they're looking for a team that can be incredibly capital efficient. And of course, it's always going to be more challenging to be capital efficient as a robotics company because you're dealing with physical, atoms and building systems, complex systems. But there is a more ruthless edge on capital efficiency. And then the third one is, again, what we found in Gen 1 is it's really easy to build one of something. I can build you a pilot that says in a theoretical, the robot can do drywall installation. It can do construction marking on a new building and do all these things. The question is can you build 10,000 of them that repeatedly do that at economics that make sense and can go through a life cycle? They can be serviced. Who's going to service them, right? How are they upgraded? How do you deal with that? That's the transition and the opportunity that's in front of us now is that companies that can figure that out, I think will be well capitalized and will probably become some names that you really recognize in 10 and 15 years. But that transition is the one we're now going through.
I'll add one other small point to it, which is I think when you think about the investor mindset, I think in this category, there's a little bit of a shift. And the way I think about this shift is that, when you look at a robotics company, it's not about, expansion. It's not about many use cases, right? It's almost about, it's better to be indexed on focus. Can you do the one thing? Can you do it really, really well in both structured and unstructured environments, right? And now if you translate that into the real world, like if you're building a robot that's on the front line, like, filling up your salad bowls, that's a lot of unstructured environments to sort of deal with. Like an employee can move from, giving you salad in a bowl to going and filling soda. But, if you're a robotics company trying to do those two use cases, these are very different use cases. And so you kind of get to the dilemma of like, hey, I have a robot that does a lot of things, but they do it okay. They don't do it really, really well. I'd rather have one thing that the robot does well, but it's replicable across multiple customers. And that's what I mean by focused scale.
It's interesting because we've had a lot of feedback from the market that things would be different if we were in a different macro environment, right? And hearing you guys talk and in our own discussions with folks, I think those things are not quite that black and white. I think the revised macro environment over the last year has triggered a reversion to discipline. And I think even if that had not happened, we would have eventually gotten to that place anyway, perhaps a little bit slower, but we would have gotten that point. And I think that point is now here to stay. So the takeaway I'm getting from you guys, and which I agree with, is that the things we're talking about are disconnected from macro. They are fundamentals that investors and founders really need to focus on.
I feel today's market is actually a great forcing function for robotics companies, right? I think if you had like the market of 18 months ago or 24 months ago, it almost sometimes serves as a disservice because you're trying to get ahead of like, repeatable use cases and getting to scale. In which case, yeah, you raise a Series B at a high valuation, but what does your C look like? And do you then take a haircut for your investors, for your founders, et cetera? And I think that puts you at a disadvantage. So I'd rather go build responsibly. And we've all seen the news articles about like, hey, it's not about revenue, it's about EBITDA. And I actually think that for robotics companies, you got to think about unit economics.
Yeah, I think that's right.
I think there are two examples that I can highlight around this. The first is in Gen 1, one of the things we learned is when you're integrating with partners, it always takes longer than you expect. And I think as an example, you look at the horizontal of robotics, folks working on perception systems, right? Up and down the stack, chassis, energy management, all up and down an emerging robotics stack. They're like, well, hey, I need to sell to John Deere or Caterpillar or somebody. And you roll in, you're like, I'm ready to go. And what you don't realize is that the typical cycle for a heavy mining vehicle, like on new phase development, is a minimum of 5 years. If you're lucky, you catch them during the design phase where you can actually get integrated. And you're like, oh, well, I'm ready to go. Can I have some revenue today? And the interesting thing is you might get a little NRE, you might get some pilot revenue. But if you're waiting for those devices to get deployed in field, you're waiting 5 to 7 years for revenue. Now, the venture community isn't necessarily thrilled about that. You might be able to even book some revenue, right? You hear these amazing stories, these autonomous aircraft companies booking, I've got, $1 billion in LOIs. Well, that's not revenue. It's not booking. It's not even a billing. But the challenge is they've got it, but they have to wait years and years and years for that revenue to actually show up in the bank. So part of it is merging into a greater ecosystem, greater processes. Yeah. And then the other one is the other story I would tell is a little bit of hubris about the market. I think in a lot of cases, Gen 1 looked at not invented here. And I'll give you an example in the agricultural space. So, this is out of one of my portfolio companies. This is definitely a lesson that I think everybody in ag picked up, which is we picked up an amazing team of roboticists who were looking at agriculture and initially weeding and was going to, so they went out and they literally spent 3 years and you don't want to know how many $1 million building their own robot and built a snowflake version of it and then went to Roush, one of the premier companies in the business, and said, hey, I need to harden this and I need to build 100 of them. Did it, took it out in the field in agriculture, and the farmers are like, what the hell is this? This is great. I love what it does. But you understand, for the last 50 years, I have these tractors over here from Deere or from Cat or from Komatsu. And why would you ask me to take a new type of machine into my farm that I don't know how to service, I don't know how to deal with? Why don't you just put your same equipment on the front end effector of my Deere tractor? And so it's a case you see in a lot of environments where, again, that knowledge of what the market wants. Yes, one way to solve it was to build your own robot, but the ecosystem wasn't really ready for a new robot and having to deal with that. Where they're like, look, if you just put it on the front end of the Deere tractor I already own and have already amortized, then we're going to do business with you. So it's sort of a costly reset. And you see this in a lot of cases where in Gen 1, a lot of market knowledge had to be gathered. Again, could you build a robot that weeded a field? Yes, absolutely. Could we spend a lot of money on it? Yes. Was it what the ecosystem wanted? Yes, but no. And I think Gen 2 will be, folks entering the market now will have the benefit of understanding some of these learnings.
And so let's unpack that, because when you were talking about the major components of what will make a scalable robotics company, you mentioned 3 things, right? One was team, which I think is what you're referring to right now to a large degree, capital efficiency, and then your go-to-market acceptance and strategy. So let's start with the first point there, because I think it's important for everybody to understand. Team. You've mentioned this, you've mentioned it, I've seen it. How critical is it for your founding team, someone on the founding team, to have expertise in the vertical that you are building your application? Is it nice to have? Is it critical? How do you think about that from an investment perspective?
Yeah, I'll give you a little story and maybe just walk you through a live example. Like I looked at specifically, one of the companies that was raising a Series B round. They were at about, and again, this was like week, maybe month 2 at Madrona. And, I kind of got interested in the category, was looking at this company. Founder was ex-Berkeley, strong robotics background. They've got one of the best programs out there. And, they're 30 million in bookings. Coming back to that bookings point, right? 30 million bookings, auto manufacturer, basically, automating the car building sort of line. And, started digging in, and, incredibly talented guys had built an amazing piece of tech. Now, you could argue that it's a horizontal or a vertical solution. You could cut it anyway. But the point being that it got real bookings from the likes of like big car manufacturers. The problem was that, now they've got these 30 million bookings, but in order to get this system up and running, he had to go put somebody on his CX team to go fly out, get the system up and running, and start collecting the dollars. Guess what? That's expensive. That's what he's raising money for. But then the second problem is that, traditionally that work was being done by, assemblers or system integrators. Now, the big catch there was, so why not work with system integrators directly and give them a commission check? The problem is that it's actually putting them out of business, because if you go build an automation solution, now their SI business is under jeopardy. And so I think there was a reverse effect of not being able to sort of scale through the partner system, which made your unit economics, again, coming back to that variable, completely messed up. Company went belly up. And, that's a little bit of a shocker for somebody who had 30 million in bookings for the year, kind of getting to that stage where they couldn't scale. My big lesson learned there was you might have great product market fit, but you actually did not have business market fit, which is, I think, where your point about BCD really comes into the picture on, are you truly able to scale without putting your own people in CX, and are you able to make that equation work? So I think while team's important, I think the second and the third criteria for me in my mind are, is it the right team? Is the moment now? Are you solving the right problem through a product, which then gets you to product market fit? And then do you actually have business market fit?
Yeah, we often ask a startup at their, because I invested primarily at pre-seed and seed and then follow on later on. One of the first questions we'll ask a founding team is, show me your value ecosystem diagram. And they're like, huh? In a lot of cases, when they show me one, I'm very excited. But a value ecosystem diagram, it's really easy in a robotics scenario to say, this robot, I'm going to build a spot welding robot, and I'm going to put it in SMB welding environment. And the welder, it's this efficiency versus the worker. So it's either augmenting the worker or replacing the worker. And so it's really easy to find that analysis. But what you forget is what you're just talking about is the ecosystem around that weld, right? To the next step. Well, what's the next thing it gets handed off to? Does it get handed off for burnishing or finishing or something else? Whose jobs, who does that job? Where the transfers go? Who buys it? Who sells it? Who's the intermediary? Who services the robot? That ecosystem that sits around the thing you're building, a lot of the times you literally have to get into the business or have pre-existing knowledge of that business before you understand all the gotchas. I always tell an example of one of our startups that didn't make it. It's a company called Dishcraft. And what they did is, if any of you have ever been in the back end of a restaurant, right, there's a Hobart machine. It's a Hobart dishwashing machine. One of the crappiest jobs on planet Earth. No one likes to do this job. It's hot, it's messy, it's terrible. So they're like, well, we'll automate this. And they looked at it, and these were some of the best roboticists we had ever seen. And we're like, and they showed us on day one a demo of it working, right? They could sort through, plates versus silverware, get them racked up and get them into the Hobart. The funny thing is you're like, well, my gosh, and customers loved it. Yeah. And they had hundreds of millions of dollars in potential, on the booking side, and on LOI definitely had that number. Challenge is they actually went out into the field and started deploying. What you realize is you can't just drop a robot into the back end of a restaurant. Happens to be a huge regulatory environment at the local, state, and federal level about what goes on back there. Let alone a lot of the back end of restaurants, that's not where anyone invests from a real estate perspective. There wasn't a lot of land back there, not a lot of cubic real estate. So what they found is the customer, the top line, the top of the chain, right? The C-suite was like, oh, I love this. This is going to be more efficient, less expensive, all these wonderful things. But when you actually went to try to deploy it, 80-90% of the time, there was a regulatory or a structural problem that would prevent a retrofit from happening. And so the team came into it with all the, I mean, this was a world-class team and experience. This wasn't even their first time at the rodeo, but you really have to look at the ecosystem around your problem before you attack it, because sometimes it's not, can I automate it? That's not necessarily the problem. Is if you can automate it, can you get it into that environment? Can you look at the business issues, technical issues, regulatory issues, and in some cases, cultural issues that might slow down the adoption? Because from a startup's perspective, anytime you got to slow down, the bigger your team, and when your team is in essence idle because of other issues, you are burning capital and not making revenue. And that sort of opens up the death spiral, right? Where you just can't grow fast enough. But it's not the technology that gates them in a lot of cases. It's these outside factors. So backing it up, it's what is your value ecosystem? What are you trying to do? Who will it affect? And do you understand that? And can you get the right people to unlock those undoubted challenges that are in almost every market segment?
So let me pause there for a second, because we've gone through a fair number of topics so far. Any questions on anything so far? Okay, excellent. Let's start with you. Yeah.
Yeah, I think if you look at it again, I'm going to break this. Oh, the question is like, how many, like what percentage due to non-technical or
Infra challenges.
Infra challenges.
Yeah.
I think the interesting thing is, I mean, there are some high visibility infra issues. I think, Cruise is probably experiencing one of those right now. I mean, if you understand what's going on with Cruise, it's an infra issue. In no small part, it's an infra issue. I'm going to assert, though, that infra is not typically the major cause of let's call it robotic startup mortality. I think it's in a lot of cases. Question I'm sitting here going in real time: is it first order or second order? And what we see a lot of is, and I'll use autonomous vehicles as an example. I'll try to put a finer point on it. I think in Gen 1, we were like, holy cow, we can get a robot to drive on sidewalks on the highway. We can put them everywhere. The interesting thing is, if you look at sidewalk delivery robotics, of which I also had another investment, the challenge was, it was, on a regulatory perspective, we actually did our diligence. We checked, and as an example, in New York City, there was only one law that we could find related to like businesses on a sidewalk or doing anything on a sidewalk, and it had to do with hot dog stands, right? Which you think that's really the only commerce that had ever been done. But the minute we started rolling robots in, San Francisco, New York City, Dallas, all the local regulatory bodies start popping up and going, wait, you can or you can't do it. So the funny thing is there was no technical infrastructure. I mean, yes, we had classic issues with comm architecture and stuff like that, like for remote teleop, like takeovers in the middle of, a congested network area. But the bigger issue turned out to be that environment, technically, the edge cases were burning us from a technical perspective. But more importantly, the regulatory environment was just a huge challenge. You had to go to every town that you went into. You had to look at the state and local level to figure out, if there aren't regulations, who do I influence to make sure they don't retroactively pass regulation, which, for instance, Washington, D.C. did as a town to prevent sidewalk robotics from happening. So there's all these, I would assert that core technology infrastructure was not the mortality thing, but it's more the environment that you enter. And the learnings, I think, that are starting to be passed forward is the more constraints you get, the better. Right. And so I'll finish that story by saying with sidewalk robotics, what you saw is a lot of people, for instance, retreat to college campuses. Why? Because the college owns the sidewalk, not 4 different municipalities, or the infrastructure inside of a large, like manufacturing plant between 9 buildings, because again, who owns that? Ford Motor Company.
It's a structured versus an unstructured environment.
Yeah. So I think one thing that we're starting to see is, how do you, when you start off again to this idea of focus, it's also focus and constraint. The more constrained the environment, the more, if you run into an infrastructure challenge, the easier it is to fix.
I'd answer it slightly differently. I think infra is, over the last 10 years, infra is being ahead of what actually is being deployed. And I don't think infra is a gating factor, because if you think about like compute, network, storage, like core elements of infra, I think those have generally not been bottlenecks, right? Like there's compute at the edge, right? So I think even in a scenario where you need computation which to be done faster, I think you can actually do that calc. There's ML models that you can deploy at the edge. There's vision systems that can happen at the edge. There's command and control with IoT sort of lighting it up. There's blazing fast networks with things like express route, et cetera, with 5G. I mean, yeah, in remote areas, yes, there is the question around like network proliferation, which is still an infra issue, but I don't think it's gating the success of a robotic startup. I think in my mind, what's gating the success right now is this challenge around ecosystem play, sort of distribution, scalability, and more business model.
Which we'll talk about more as we go through that. James, you had a question.
Just on the topic of capital efficiency, I represent a team that comes into early stage startups as kind of an augment to their core engineering team. Talk to me about the pros and cons of like team dynamics. Do you go out and hire a CTO and then build a big team immediately, or do you hire just a couple key people and you encourage augmenting some of that early development?
Is that question more from a enterprise customer perspective or from a startup perspective?
Both. Yes.
Yeah, I think from an enterprise perspective, if you're looking at it from a customer standpoint, it's a little hard to say, hey, we should go hire like a large team. Because I think the obvious question that you might want to ask yourself as an enterprise is like, what's my core business? Is my core business, like if I'm Coca-Cola, let's take that as an example. Is my core business selling, software things, or is my core business sort of building robotic systems for optimization? So it comes back to the question of like, do I buy or do I build? And I think often people want to experiment or take baby steps with the buy or partner, and then think about like, hey, do I want to build? I think it's no different in the cloud, right? I think, part of the movie that's played out with the cloud is that, people don't want to manage their IT, right? They want these hyperscalers to go manage their IT. Could you see a world where somebody else is, you want to partner with somebody else to manage your movement systems or your supply chain through robotics? I could see that world. Yeah. So I think that's from a customer standpoint. I think on the startup standpoint, you just got to go build responsibly. And I always, sort of go back to if you're a startup, if you want to be capital efficient, what are the stage gates that you set for yourself as milestones you want to achieve? The first of it being 5 happy customers.
So I think we had another question. Yeah.
Can you elaborate a bit more on the distinction you make between product market and business market fit and how those may or may not line up?
Yeah. I think the simplest way to think about it is if you've built something that's created value for the customer, great. You've got 5 customers, they're using your product, the usage is going up. That's product market fit, in my opinion, right? You've got customers who want to use your product. You still have a lot of questions unanswered. Is the pricing right? Right? Is the business model right? Do I have a way to service the product that once somebody is using it? Who's going to distribute it? What's my partner channel story? Am I going direct? Am I selling through a partner? I think there's all these, like, what's my CX story? What happens when the damn thing fails? I think these are all questions that you generally want to sort of think about, even in the early days. But at the same point in time, really have crisp answers as you think about scaling beyond the first 5-10 customers. So that to me is the distinction between product and the business market fit.
Are there other questions before we? Yep.
So you talked about exactly the business market fit like that, right? So
can you speak up a little bit, please?
Yeah. So when you choose a company, right? So for example, you talk about also hyper focus, pick a vertical, pick a task within that vertical, and just do it well.
Yeah.
But then at the same time, you might also be investing in a platform robotics company, saying, humanoid platform, we don't know what we're going to do yet, but we're going to make this the next thing 10 years from now, right? So how do you balance between those two companies? Because one's going to eat the other's lunch, hopefully, right? And so how do you choose, or do you just do a broad investment like that and hope it all still pans out?
You want to take that? I'm happy to take it.
Go ahead. Welcome to the age-old debate. I think almost every robotics company relatively early in its life asks the question, am I a vertical or am I a horizontal? I can tell you after too many years in the business, if you think about very, very successful platforms in precedent scenarios, it's often a case of it's a vertical that tips over and becomes a horizontal Just historically, it tends to work that way. Starting out right now saying, I'm going to build a horizontal robotics platform, at a minimum, is a massive commitment from a capital perspective. And then again, this issue of focus, it's great to say someday my humanoid robot will service 19 different markets. But again, I'm going to turn around and say, what is your LAM? What is your launch addressable market? Where's the first customer who can say, I know someday that this humanoid robot will be able to do 19 things, but I need it to do this one thing and I need to be happy. And so the challenge is again, I think in a lot of our experience from the venture side and from platform building side, it's like, yes, you maybe the best way to approach it is potentially to say, yeah, I start vertically with an eye to being horizontal. But again, starting from horizontal in terms of the revenue expectations that the market's going to put on you, it's tricky. And there are folks who are trying it in robotics right now. I think in almost every subcategory, if you look at chassis or some other areas, there are folks like,
Yeah, I'll be a little contrary to that. I think it also depends on what your thesis is and how you're balancing your investment as a portfolio from a VC standpoint, right? I think you might pick a few robotics vertical investments to make, but then I'm a platforms guy and I'm like, I get enamored by platforms, right? But if you're a software robotics company, I'm like, okay, I could get comfortable with building like a, ROS kind of, competitor or whatnot, right? I mean, I think, think GitHub like model, right? Of course, you've got to go get developers or builders onto the platform. So I think there could be one thesis that leads to that. But I think Eric's generally right that, the two big questions you want to answer is what is your wedge? And I think the other thing that, I generally look for is whatever solution you're building, like, is it solving the problem 10x better than anything else that's out there? And I think it can't be marginally better. It's got to be so much. It's got to be 10x better at least, where your customer is saying, if you build it here, take my money today. And I think that's generally the right litmus test from a vertical centric solution. But again, I think if all of us had a very quantitative answer to it, like AI could replace investors, and maybe it will, but
I might
not yet.
I might push back on both of you a little bit, and I'll refer to Tim in the back of the room who gave me inspiration for this. In the last session that we had, we talked about sort of the role of generative AI in sort of managing fleets and federations of robots, right? So if I kind of zoom out from that and then think about some of the applications that are developing as more of a software layer for robotics around command and control, right? That could work across different fleets doing different things in different environments, right? Some of the things that are focused on managing autonomy from a software perspective that are merging in with fusion, with sensors, et cetera. If we think about those things from a horizontal perspective, it seems like those types of applications have the potential to be horizontal by serving as kind of infrastructure glue, as opposed to simply relying on a vertical to kind of achieve.
They certainly do, and I think for those, you might recollect our discussion. We probably looked at a company, or I at least looked at a company which was low code, no code version of having any robotics arm sort of do the function by using this platform, drag and drop, and bring me any arm and I'll be able to get it up and running in the next 10-15 minutes. And the tricky part there was, although you're selling the platform and licensing it, like most customers of that company came back and said, oh, it's great that you're building it. I just don't have the talent to sort of go build out a finished solution. Can you do that for me? And very quickly, it went back to my earlier point about they actually started following the money. And so you started building applications on top of that, which means that you've got to go build vertical expertise and, operating machines or operating lathes or whatever. And I think the company started going down the route of like being an SI, because that's where the money was.
Then you've got examples like ClearPath that traded for 25 times revenue 2 months ago, that is providing a horizontal solution to different, AMR type applications, right? So I agree with both of you.
Trading it.
Well, did, right? But I mean, at the end of the day, that was the selling price for the business. The reality, I agree with you guys, but I do think one of the application opportunities is to think about that glue, as I'll call it, right? And think about, is there an opportunity to do something that brings things together from an application perspective with the hardware? And I think as we think about scaling our businesses, one of the things I think, that's the alternative derivative sort of robotics application that could define a horizontal category. So
I'm actually in agreement. I'm going to come back to this capital efficiency point, which is in Gen 1, if you look at a robotics company, when they go to deploy with a customer, most of them whether they wanted to or not, built the entire stack themselves, right? So teleop, control, they ended up building it. And you ask them why, and they're like, well, I didn't really find anything that I liked. And boy, I had this really specific requirement, my safety and security system. Oh, well, I don't have, if I have one, we built it ourselves. We built our own e-stops. Why? Well, we couldn't, the e-stops that were out there were really expensive and they were hard to use. So we did it ourselves. And so you end up with this, you end up having, from a capital efficiency perspective in Gen 1, the teams were huge because they own every piece of the stack. And so the funny thing is, there's a new term in the business, and it's really in its infancy, which is the CRO. Like if you talk to Walmart and large logistics companies, they're starting to have many robots in either pilot or light production inside the building. And when you walk into their modern cloud infrastructure, their command and control center, you see just huge number of heterogeneous monitors running. And you're like, well, how do you teleop across your fleet? And they're like, well, I go to this command console for these, and I go to this command console for these. There's no integration yet because everybody built everything bespoke and vertical. So I do agree that in Gen 2, you will start to see some people start to cut across the layers and say, guys, why are we all building the same teleop or same chassis, ClearPath, saying, look, there are going to be 4 or 5 major chassis types, right? For, wheel, tread, ... humanoid. You'll see people start to say, well, why don't I try to horizontal across these, or at least get, start that. And that's, really, if you look again back in history of platforms, this is sort of what happened. Even, someone mentioned Windows, 98% share or whatever, right? I'm old enough to remember, when Windows wasn't there. And part of it is at some point, like on the networking layer, right? You woke up one morning inside of a building and you had 5 different network protocols running in the same damn building. And somebody finally says, wait a minute, maybe we need to, tip this over and have that. So I think we are now heading, I agree with you, we're heading for the first opportunities for some of those layers to start to have somebody come up and say, hey, rather than you invest and be capital inefficient, why don't you just use the solution that I have?
Yeah, I think that's a good point. I think just a few other questions I want to
just want to make a quick add to that. I think the other add to that is when you're looking at a platform investment, I think the acquisition cost of builders on top of that platform is probably always underestimated in my mind. Whether it's developers, whether it's ISVs, whether it's applications, oftentimes I think, I've seen a lot of patterns where, teams have come and said, oh, we're going to build this. It's going to be amazing. And like, great, who's going to build on top of that? Oh, they'll come. And I think they'll come is a little bit of a misnomer where, unless you've got willingness to spend high on the CAC side of things, like people don't build on your platform just because it exists. I think there's got to be like 10x the value.
Right. Like if you were doing as an example, and I keep picking on this one, like in remote teleop right now, you roll into Waymo or Cruise or all those folks and say, hey, I've got the most amazing teleop solution you've ever seen. They're like, that's awesome, but I'd like to hire maybe your employees. But in essence, we're so far along in our path now that the switching cost is really high. So when you're coming into the market, the CAC part of it is you got to catch the curve at the right point, and maybe you're having to invest in startups and you're waiting for them to grow up before your revenue can grow up with them. So again, it's understanding your ecosystem. Even if you're going to go play this horizontal game, you got to understand, well, how fast could the market adopt what I'm doing? And is that fast enough to satisfy the capital requirements of my partners?
That's a great point.
Help standardize a lot of things such that my grandparents got a computer after that. Like, for robotics, are we sort of at that stage where there's enough like coherency over certain platforms or certain hardware providers so that people can now start gluing things together for their specific applications, or are they not quite there yet? Like, has robotics hardware and technology and software, has that become commoditized enough such that we can have like a sort of a Windows moment in the robotics space? That what Windows did.
Yeah, I think it's a fascinating question, and I think we're closer to it than ever before. And I don't think I can give you a yes or no answer on this, but I think in the maturity curve, the way I think about it is, I think fundamentally even AI is sort of going to be amazingly additive towards getting to that to that point. I mean, I was just talking to one of the engineers yesterday, and this PM on this big enterprise company wants to learn Python. I'm like, great, why do you want to do that? He's like, well, because and the other guy who was in the room saying, oh, you shouldn't learn it. Why? You should just ask ChatGPT, like, what do you want? And so I think to the extent where you can see those things now being accelerants towards generating the level of code and getting to that sophistication level, I think we're close to that point. Now, of course, there's always going to be bespoke systems with new hardware coming on point, and I think there's still going to be some federation. But I generally think this is why I believe that your vertical expertise is probably going to be the wedge to sort of get there, and then the horizontal thing just becomes commodity.
That's French for no.
Yeah.
I mean, that's kind of step function.
Yeah.
But I mean, in that Gen AI, for example, that's much more on the software. Like the Gen AI is almost a platform.
Yeah.
Potentially plugging things in together. But that doesn't necessarily mean that like different hardware components.
Yeah.
Because like
the thing about the thesis that I've kind of grokked in my head is I think over the period of time the complexity of hardware is now moved into software. And I think I'll give you an example and why I say that. And maybe Eric's going to disagree with me. I know he's going to disagree with me. But I think I think there's a question around like back in the day you've got to go build an arm that has fingers on it that exactly knows or has to know how much pressure you're going to go apply if you want to go pick a strawberry. But I think now there's sensors that can actually be smart enough to then go back to the piece of like ML model on the edge and real time determine how much pressure do I need to apply so I'm not squishing it or crushing the glass, or all I need to do is get the arm in the vicinity of that object where vision system is going to figure out like how do I need to shape it. So I think there's some level of hardware complexity that gets moved into software. And my thesis is that more and more hardware starts to become, I would say, commoditized, if that's the right framing on that. But I do feel that software can sort of get to the point where it's solving most of the complexity.
One additional question. So like in this example of like generative AI is acting as kind of the platform, why is it that personal computers or smartphones didn't need AI, but robotics now seemingly might need it?
I think every endpoint will get there. Right? I think every endpoint will sort of get to the point where, I mean, I just saw that video of that, or whatever that chip was, or the device was. I don't know if you guys saw it, but it's been making the rounds on LinkedIn where it's almost like an AI type of device.
Yeah.
Sort of being, yeah. I mean, is that a cell phone replacement? I don't know. Could be. But I think, I do think that devices will purely exist, in my opinion, for the compute power that they provide. But all the software is sort of going to be intelligent enough for you to route, for you to do purchasing, for you to do voice detection, etc.
So I'm going to go hard contrary on this one, which is, by the way, a huge opportunity for everybody in the room. and really and it goes back to this horizontal question. So if I asked all of you, what's your chassis platform, what's your energy management platform, what's your perception system, what's your teleop system, what's your fleet management solution, what's your fleet control, like your fleet action engine, I don't know how many times I would get the same answer out of any of you. I think we were starting to see precursors with again, in chassis, there were 4 or 5 chassis vendors. If you look at ARMS, UR, KUKA, I can start to, but by the way, the end effector attached to that robot arm, freaking Wild West right now. So I think the opportunity is we will need to, as we create a platform, start to get some more standards so that individual vertical startups can be more efficient. But even on the hardware side, I think above chassis and maybe ARM and a few other areas, we still have a long way to go. And then on the software area, again, you go into the back end of any company that's deploying like an Amazon or a UPS, Deutsche Post, the people who are doing logistics, and you look back there, the software is truly terrifying. But that in the sense that it is completely heterogeneous with no crossover. They cannot glue tasks together. They'll ask you, would you write the special code that glues this to that, right? But that pain is going to open up opportunities. The customers will start to, as they do more robotics deployments, will say, look, as a requirement, please use this standard, or please work with your partner, and 3 partners will end up gluing together something that becomes a standard. That's how it always happens. It is finally getting to the pain point from a customer perspective in terms of number of robotic deployments, that pain is real, and then that pain will get solved and we will head for platform. So I don't think we're anywhere near there, but I think this generation of entrepreneurs gets to take a crack at the revenue associated with creating those solutions, right? And those people either tend to make the standard or get hoovered up into the standard, which means their companies tend to do fairly well in the schema of, were you successful? Did you have a successful at a minimum, a successful financial outcome?
I take that as
that's a great transition point, because we have about 15-20 minutes left, but that's obviously the inflection point that a lot of people are looking for in terms of how to build an ecosystem. But I want to spend a few minutes talking about the fundraising, pitching sort of side of the equation, because I think that's very important, and how do you do that well. One of the key takeaways that everybody should have from this is that everything we talk about next will be, I don't want to say repetitive, but we'll put the concepts that we've discussed into relief, right? So how do you take the things that we have talked about and then think about making that into an effective, fundraising effort, and what's important at different stages, right? So the first very open question to both of you is, what actually, as an investor, we've talked about the different components, but what makes a good pitch? Like when you're talking, what makes a good investor deck? What makes a good pitch? What are you looking for?
First thing you got to do is, when we talk about funding, you have to break it into where you are in your life cycle. There is what we call pre-seed and seed, very early stage investing, Series A, and which is it is the true wall of death for most startups. And then what we call the growth round phase, B, C, D. These are just series of funding, assuming that you need them. And each of those, while there are components that are the same that we look for, each of those has a distinct set of requirements that if you don't understand and you go into the room and aren't able to articulate them, you'll be at a significant disadvantage. So we'll break those into pieces, and then I think we could say, hey, for pre-seed seed, what are you looking for? And we can maybe do.
Let's start with that then.
Okay.
Let's start with pre-seed seed.
You want to go?
Sure. Well, I'll start. The pre-seed and seed, we call this the dream and team phase, right? Where what we're looking for first and foremost are I'm not going to say universally, but a lot of folks what we're looking for is the quality of the team. And again, I'm going to come back to the statement sort of Gen 1, what we were looking for is amazing engineers, right? Mechatronics wizards, right? The people who could automate the problem. I think in Dream and Team in the next round, it is those individuals paired with either one of those mechatronics engineers or one of those great, perception engineers or whoever it is that's the founding team. Someone's got to understand the market that they're entering. You can't enter the market blind, because you quickly move from a technology problem to a product and business fit. So in Dream and Team, I love to see the combination of someone who understands sort of how to run the company and scale the company early on, sort of the quasi CEO. You've got to have some technologists who are really good at the wedge. I'm trying to steal that phrase there. And then the third thing is, and they can be combined in individuals. They become unicorns if you combine too many of them. But the third is someone who understands the market that you're going to go build in. So someone with practical experience in the area, so that, when you have to unlock first sales, when you have to find 5 customers who could say, I like this, that you have an easy path to do it. So team is the most important, and then really articulating a solid idea of what you think the business opportunity is, the core unit economics, G to M. It's all in the template, by the way. There's a standard template for it. It's just how well you answer the questions, knowing that you probably don't know the exact right answer. In a lot of cases, the VC doesn't know the exact right answer. We're just more looking at how you think about the problem. Did you do a value ecosystem diagram? Did you think about the bigger picture? We may not agree as to what the right entry strategy is, but if you're able to articulate it, that's 3/4 of the battle.
Yeah. I'll say it slightly differently. I think the team is definitely, the big bet, right, at this stage. I also generally tend to gravitate towards founders who know that space in and out, like 100 times more than anybody else I've known, or definitely me. Because I love to learn from founders who are really deep in that space and who studied that problem to the nth degree, and who have really high conviction on, like, why is it a problem now? Or why is this the best team? And is there an inflection point in the market now as to why is this something that needs to be solved now? Or what's the driving force behind it? Like, is there a tailwind? I mean, I think we talked a little bit about like a technology trend, right? Like, is AI sort of giving you something special, which you've had a realization that you're applying it in a different way? And so I think I generally tend to look at like, what's the problem? Is there a very crisp articulation of the problem? Is there a t-shirt sizing around like the size of market? Like, people come up with like super precise numbers. I think, you could argue that it's a $1 trillion market or $2 trillion market. Who cares? It's still a big market, right? So I think we're looking at t-shirt sizing, but really trying to understand why now? Like, why is it the right time to solve the problem? And I think what is unique either in your team or the solution you have or sort of the IP you've built so far or your depth in the domain that's making you the best person or the team to solve the right problem. I think at the early stage, those are the kind of open questions. I mean, I think all the value diagrams, the GTM stuff, I think it's great to have a point of view, but I don't think that's the crux of what I would look for at that stage. But I think you're right in terms of like,
So,
if you don't understand that, you're going to miss it.
how does that, so that's helpful. Now let's maybe migrate that into A round, right?
Yeah.
So what are the things you need to see differently that the company's done from seed to A that make it a compelling A round investment?
Just really quickly, one little
Yeah.
point. Everybody in the room, there's three things we talk about with any opportunity. Is it obvious? Is it inevitable? And when? I think you highlighted some. I just want to jump on this really quickly. Automation is obvious. It is inevitable. The question for any opportunity is when. And there are a lot of cases where from a business perspective, it's a little early. And being able to answer that, right? And how much capital you have to wait with for it to become the right time. So that right time is a big one. It's the hardest one to sort of figure out. Transitioning from pre-seed and seed into A, the big thing that happens in A is you've started to hire people. And what we're starting to look for is product market fit, right? They say the transition from seed to Series A is, can you demonstrate product market fit? And can you demonstrate sort of technical mastery of the problem, right? Do you have the right product? And does the customer actually believe you have the right product? And the way that is demonstrated to venture capital, at least, is through revenue, right? We often talk that Series A used to be you had to bring in about $1 million in revenue. And it was just this, ask, 10 venture capitalists what $1 million in revenue really means, you'll get 11 answers back. But in general, that has drifted up now to more like 3, 2, 3, 4. I've seen even 5 in some cases of revenue. So again, even when you're starting your company, you've got to think, who are those first 5 customers and can they demonstrate either in the quality of the revenue, maybe the land and expand opportunity associated with the revenue. So it's not necessarily a hard number. But if you have a customer who loves it and is willing to articulate that to a venture capitalist, and by the way, they own 19 manufacturing plants and they love it in their first one, that's high quality land and what we call land and expand revenue. But you are trying to convert from, I have a team, I have a dream, to here's the demonstrated path to first customer revenue. And that's one of the big swings. And you start to look at how they're growing their teams. There's a bunch of factors that kick in, but A is really gated by, can you swing it into revenue and, like, for instance, customer NPS?
Yeah. I think the proxy for revenue also at this stage is the logos, the customer logos, and even the usage, right? How are they using your product? Like, is it quintessential? Have they bought it and they're not using it? You might have the logo, but if it's not getting used, like, what's the point? Is it in a critical workflow for the customer? Is it good to have? Is it nice to have? Or is it existential crisis for the customer? I think those are some interesting questions to sort of go answer. The other thing I generally look for is, what's the pattern of commonality between customers? Like, are your customers just spread across and you've gotten whoever you've gotten to give you a check? Or is there some sign of repeatability amongst the cohort of customers that you've been able to go attract? And I think, coming back to that point about wedge, how did you approach the customer? Like, was it a referral? Was it a family friend? Was it you doing a cold call? Was it somebody in your network? And nothing wrong with having people in your network, but does that fit your ideal customer profile? Or is it a departure from your customer profile? If it's a departure, I'm a little worried. And I do want to highlight one other point that, oftentimes I've seen a lot of startups come back and said, oh, we're ready for an A. I've got bookings. But this is where I go back to like, is it revenue? Is it bookings? Is it an MOU? Is it an LOI? And I think, the other thing that generally tends to also come out is, as you talk to the founders, one of the pressure points is, what does your forward-looking pipeline of customers look like? Do you have 5 customers identified? Are any in flight? If there are any in flight, I often like to see, hey, so how long is it going to take you to close a customer? And I've seen people give me an answer and said, oh, it's going to take me 6 days, and it's taking them 6 months, and I've heard nothing. In which case, I'm like, okay, great. That's probably not a repeatable point yet.
And so we've talked about a few things now in growth or seed and A. I want to be a little bit mindful of time. What's the major pivot point in a growth round, right? What are the key fundamental differences that companies have to demonstrate to get growth investors excited in robotics?
Well, if you entered and I'm just going to, this is buzzword bingo, but like you understand your ICP, you're starting to penetrate your LAM, launch addressable market, ideal customer profile, right? You've started to figure this out. You're starting to figure out G to M or go to market, right? When you swing into Series B, like when I sit on a number of boards, and before A, we talk about, can you build the product? Yeah. The minute you raise your A round, everyone gets really confused because I walk into that board meeting and all of a sudden I start speaking a completely different language. Yeah. I'm like, all right, let me take a look at your sales efficiency on your sales pipeline. I need to see transitional loss. I need to look at capital efficiency per employee. I'm looking at top line growth. I'm looking at the quality of the customer. So what's your logo count? What's your logo conversion rate at each stage in the sales pipeline? The minute you swing into A, everything changes. There's almost like this assumption that you can scale from a technology perspective, and we'll go into that in the second half of the board meeting. But the first half is all about sell, 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 sell more. And so all of a sudden, your founders, you've been spending years building this robot, this amazing solution, and all of a sudden you go from one set of challenges, all of a sudden a completely new set of challenges pop up on the board. But growth around capital is literally growth. Yeah. It is moving from, let's say, from A to B, moving from $2 to $5 million of annual, let's call it ARR, just however we slice it, up to 10, right? Yeah. And a lot of times that could be 15. Series C, we're looking at, because we want you to be growing at 2 to 3x revenue year over year.
I mean, I typically like to see 6x pipeline, list of customers. I typically love to keep a keen eye on LTV to CAC, because that tells me that, you've got customers lined up and the only thing that's gating you is salespeople, or, you've got people willing to give you money and buy your product, and you're gated by physics today. And I think those are the 2 metrics that generally tend to come to bear on the B round.
And hopefully for people in the audience that are starting companies, you encounter a phase of growth where you actually have to deal with these problems, right? Because that's a good sign. What I would say, at least from our perspective, and we've got a couple of companies we're working with for fundraisings right now. You raised a really interesting point, Eric, and Aseem, you hit on it. The perspective on those metrics has become a lot more disciplined and a lot more lofty, right? So whereas in 20 and 21, a company seeking B round could get away with kind of mid-single digit revenue and get a 9-digit valuation. Now you're looking at companies that have to do, high single, low doubles in revenue. The mix of that has to be more ARR focused than CapEx focused, and you're not going to get to the same valuation post that you would have 2 years prior. And so as we've talked about all these things today, the important thing as we boil it down into what does that mean? It means that the discipline, the efficiency, all of these tangible aspects, you have to really think about how do you get there before you really start your company, right? I think that's one of the biggest takeaways from this is don't just take the idea and hope it works. Think about all the things we've talked about as an end state, and then figure out how is it what you are building gets you there, not in a theoretical way, but in a way that's more tangible. I think that's a big takeaway that people should have from today's conversation.
Yeah, I think one of the point I'll add is, look, I'm not a consumer guy. I've never been a consumer guy. And so I don't understand that business when people say, hey, just go get share and, gross margin will come. That doesn't compute in my head, right? And so I think at the B stage, when you're an enterprise company, I generally tend to look at what's your gross margin today and how do you expect it to be? How do you expect it to go from negative, because you've poured money into it, to break even, to positive, and to cash flow? Like, that's what I want to know. What's the plan? What's the bridge? And I think that goes back to the bit around like unit economics. Don't spend ahead of the curve, make sure you've got responsible growth and LTV to CAC. And I think all those things we've already talked about.
There's an old adage that for startups, early stage, the first thing you're focused on as your company is the expense associated with building the product. When you move into Series A, the eyeball moves up to top line revenue, quality and expansion of top line revenue. When you hit Series B, then the eye goes to net.
Well said.
And it drops into, well, you got to keep growing, but now we've got to, bring the expenses in line with your growth. So we give you some latitude to grow pretty rapidly. So your robots and the overall, the infrastructure cost of it may be high for a little while. As long as you're growing for, improving the customer wants it, we can help you on the expense side. But it goes sort of 1, 2, 3. Can you build it? Can you really drive top line revenue? And then can we squeeze your expense side to get to really good net margins? And if you can go through that transition as a robotics company, you're in a great position to raise capital.
You're in a really good spot. And everybody points to Locust Robotics as, because that's easy to do. And we can all look at the headlines. But if you actually talk to the founders of those businesses and you actually look at how they've scaled it, they had a founder that understood the problem. They developed a very specific, simple solution that solved the biggest pain point within a warehouse environment. It was across brownfield and greenfield, right, within that, and they were able to scale it at a BOM cost that was extremely reasonable, supplier diverse, and easy to access. And over time, with the right backing, they were able to scale that into what that is today. So while we don't want to point to these great successes as go do that, there are takeaways from each of those things where the lessons, right, will help inform, how you think about, your business. And that's the important thing to do. Everybody can say, well, why aren't there more Locusts? Well, the reason is because we aren't focusing as we start these companies on the things that made Locust successful from a category perspective, right? And I think that's one of the big takeaways from today that we hope that everybody has. I want to stop for a second. We're kind of running out of time. Are there any questions in the audience that we can answer, or have we tired you guys out? Okay, we got a couple. Yeah.
Might be getting that horse at this point, but you're talking about knowledge of the industry. Even I mentioned like there are a lot of unknown unknowns. Like no one knows everything. Like you want to for the dishwashing, you want a chef as your co-founder? Do you want a real estate developer? Do you want someone who owns 100 restaurants? So is there something you can do to keep your customer from just saying this is too much trouble to deal with and throwing your product out the first time you encounter stuff that you encounter a difficulty? Is there how do you stop like the first speed bump from just absolutely destroying your course in that room?
Yeah, I think this is why it goes back to the first point that Eric and I both mentioned, right? Team. I think you are going to have that shit of like, hey, like I thought I was building this and you wanted that. And, there's going to be that journey, right? And I think as long as the team's, curious, as long as the team's sort of embracing feedback and, synthesizing feedback in manageable ways to sort of not go too far, because sometimes, it's just not the right customer. Maybe it's not in your ICP, or, you're talking to the wrong buyer. Sometimes it's about like you're building the wrong thing or you're solving the wrong, problem. I think as long as you've got a team that's tenacious and the team that's, synthesizing feedback in very systematic ways, that's the early part of the grind.
I think the bigger answer to that question is, what is the actual value proposition of what you're doing? If it's significant enough, right, to where the solution actually works, then I think you're willing to work through some of those speed bumps along the way. If it's not, then it's irrelevant.
Get an unfair advantage in terms of the ratio of unknown to known. When you have a market expert, an operator from that space who joins that team very early on, there's a bunch of things they already know. You can't stop unknowns. Just get the ratio as best you can, and then it falls to sort of grit and flexibility. I mean, no plan escapes the engagement with the customer, but if you understand the customer, at least you've got less unknowns that you're going to be fighting from day one.
And if I might just add one thing, right? I don't think you're ever going to get it 100% right, because what my learning is that as a founder, your buyer might be different, but who actually uses the product might be entirely different. And so I think, you might have a manager making a purchasing decision on the front line, but the person who's operating the lathe machine is the one who's going to go use your product. And so I think you can't say, hey, who do I want to have as a founder? Do I want a manager who's a buyer, or do I want the operator? I don't think there's a right or wrong answer, but I think Eric's put it well, which is like, hey, get the knowns to unknowns ratio pretty high.
Any other questions?
So, news to me today was he said Series A is when you establish the product market fit. I always thought that, holy crap, we have to do all this before you get to seed. So then what exactly is the threshold you look for when you're saying, okay, here's a seed round, go do something with this money, right? Is it like I come to you and I say, hey, I really want to build something that turns tap water into beer, or do you expect me to come and say, I have something that can turn tap water into beer, and I just need to start figuring out how to build it?
I think there's different founders that have different assets to bear, right? Some have a big bold vision to say, hey, I want to build something that converts tap water to beer. I'm like, great, take my money. Or there might be others who are saying, look, I have a patent that I want to monetize, that I think I can build a product around, which has gotten me there, and I have some defensibility. And I think you might get both. But to answer the first part of your question, I think if you think about Series A, like, the revenue number might come and go. As Eric mentioned, it might be 1 today, it might be 5 tomorrow, 3 later. But what I do look for is, what's the customer usage in critical path? Like, do you have 5 happy customers? And I always go back to this, like McDonald's Happy Meal sort of, corollary, which is, do I have 5 happy customers who are using my product and who are loving it? Like, that to me tells me product market fit, or the early signs of it.
Yeah, there's this phrase we call NPS, right? Net Promoter Score, which is a really easy way to judge customer satisfaction. There's a newer model that's become, I think it's the McDonald's model. It said, what we do is we'll call a customer and we'll say, if I took that product, I'm going to rip it out of your hands tomorrow. It's mine. It's not yours anymore. What does the customer say? They're like, you can take it out of my cold, dead hands. You've got a customer that severity, frequency, and value are dialed in. I know it. And so that's that transition from seed to A is almost can trump the number. Is if you can find that there are a lot of customers, if one customer manifests, severity, frequency, and value as very high, and you look in the market and go, wait, there are 10,000 other more of these, or 400 more of these customers like that match the ICP. I'm like, I may even, not focus on the exact dollar amount, but it's the quality of the customer and that attachment to the product that is the transition from seed to A. Hopefully it's tied to some revenue that's demonstrative of it.
And transaction size might also sort of play a picture, right? Like, if you're licensing something for $10,000, like, that might be easier compared to something that's $1 million.
We've had people come up to us at pre-seed who know the entire attack plan to A, and some that don't. But in general, it's a sort of a variable slide of, how much data you have and how much we trust that you can get to the other data. And climb the mountain to A, which is to have a customer come back to us and tell us, yes, this product absolutely, meets a need for a large market.
The other thing that we've not touched on is diligence, right? I think investors will expect your investors to call up your customers.
Yeah, that voice of the customer is critical, especially in that early stages.
And I think those are where, like, these critical elements come. Like, I've had customers tell me that, oh my God, like, why isn't this a real product? And we're like, oh, it's not ready. And they're like, what are you talking about? It's in my production system. I'm like, oh shit. Like, they really love the product, so it's in the production system. And on the flip side, we've also had customer calls where they're like, who's using it? Like, oh, it was just a POC. Like, we're not ready to buy yet.
Again, I will echo that. I have flown to factory floors to literally watch the product. And I'm like, you talk to the operator, you talk to the manager of the operator. We do that level of diligence. And when you see a happy customer, you're like, boy, I need to make an investment, right?
Yeah, because that creates the need and that gets you excited, right? I think that's one of the biggest diligence points of VCs today in that A and B round as you land and expand, is that voice of the customer. So, listen, I think it's probably time to wrap up the panel. We have some closing remarks from James at Fresh Consulting, but please join me in giving a big thank you to Eric and Aseem for their insights today. Really appreciate you guys joining us. We'll have some time to mill around with some drinks, but let's stick around for James to finish some comments here. Thank you.
We doing? I don't know if I need the microphone or not. I'm going to try to be super quick. We've got beer, we've got food, we've got friends and colleagues in the room we want to catch up on. But in the spirit of Thanksgiving that's upon us, I just want to say I'm super grateful and thankful for all of you here. Firdaus said it best. We've had 3 events now to start the year. A lot of people have been continuing to come back, so thank you for that. Thank you to Firdaus and Aseem, our partners in getting this off the ground. Eric Klein, who's friend and also, partner at Fresh Consulting and a lot of the work that we do. This whole year was, in the spirit of startup fundamentals we've been talking about. This was our sort of market development year. We're doing needs analysis. We're trying to figure out, is there a market fit for this alliance that we're trying to build this year? And I think the answer is resoundingly yes. We've had, 3 events, 80 plus attendance on most of them. We've got a lot of great momentum in the community. And so I think we're getting there. I think I said this at the close of the last one, the concept of this alliance is not new. We've got Mass Robotics in New England. We've got Silicon Valley Robotics in the Bay Area. We've got the Pittsburgh Robotics Network. We've got others popping up in San Antonio. And so we have the privilege of being able to build on the back of some really excellent proven economic development models, and we're planning to do the same here. And all of these other agencies, they want to see us succeed. They want to give us the answers to the test. They want to help us with the things that have made them successful. So they're looking forward to having another chapter, join this now newly developed U.S. Alliance of Robotics Clusters, of which we will be a big part. And so, looking ahead at 2024, there's some ambitious goals. We're probably going to get to a few of them, but I think, to me, they kind of break down into 3 things. We've got a small website going already. There's a lot more we could do from just the digital standpoint to really connect the rest of the community and create a lot more visibility and collaboration of what's happening in our backyard. So just from the website standpoint, top of my list is we just got to get a listing of all of the robotics companies in our region, robotics adjacent, on the website hosted. We want to get demos, videos of the products you're building. We want to get your pitches. We want to get your use cases. We want others to be able to find you and say, hey, I'm, building something complementary. We want to just find a way to make some visibility and connect everyone. Amanda Mars and a couple others and I were talking, get a hosted job board. There's a lot of hiring going on. If our website can be a central place for all of the available openings and jobs and things that people are hiring for. So we definitely want to build that. And then, links to trusted vendors, reps, other useful resource links. Let's have our site be a host of all of that. Looking down just at the community, of which all of you are part of, I think we definitely want to continue with a large series of events throughout the next year. So I kind of broken those into like 3 categories of, there's a community series. So I think, on the back of a job board on the website, let's have a career fair next year. Let's talk about, resume best practices. Let's get people together that are hunting for jobs. I know the Silicon Valley group does a robot block party every summer. That's always hugely well attended. It becomes a big demo showcase. People bring the stuff they're physically building, get people involved. So we'd love to do something like that. Continued startup pitch fires. I mean, this year we saw some of the most exciting robotics companies that are being built right now pitch in front of all of us, and we got some good feedback, some good remarks from them. We want to do more of these, continued education series. I've kind of broken that into like a founder series, if you will, where we do a lot more skills training. I think similar to what we've done here today, leadership training, business management for engineers, finance for startups 101, lean product development, how to set up your supply chain, things that are really critical that brilliant technical founders might not just have in their back pocket and their expertise. Something that the Mass Robotics Group does really well, and it's kind of anchored to the fact that they've got a real estate model tied to their alliance, but they'll bring sort of industry vertical leaders to their hosted piece of real estate where they can get eyes on upwards of 80 different robotics companies in one sitting. Bring a lot of your potential customers to one place. That's kind of more of a long-term goal, but I think there's some industry corporate development work that we can be doing. And then the partners. I think big goal for me next year is figure out how our alliance can work really well with a lot of the existing groups already in our neighborhood. We've got Seth Abelson in the back there. If you raise your hand, he's from WAVC. doing some really impressive stuff with, autonomous vehicles, subsea ROVs and things like that. It's a great group for us to figure out how can we complement and connect and amplify our efforts. We've got an incredible AUVSI chapter here in the Northwest. We've got Lila Moet from the First Washington represented in the back. We've got to be able to connect to our STEM community here. Who else am I missing? We've got the Center for Advanced Manufacturing in Puget Sound that are looking for ways to modernize and get into sort of Industry 4.0 practices within some of the legacy manufacturers in our region. We've got the Western Growers Association, which really brings in the industrial ag side of our state on the east side. We've got to figure out how to work with them. UW, OSU, any of the academic institutions in our backyard. So that's kind of a big one for me, just figuring out how we can start to collaborate and connect better. On the nonprofit side, we're really just, I've been taking a lot of notes, and thank God my partners are from the world of venture and capital market investment. But, we're getting to a stage right now where we're going to go out to the community and start to actually raise our own funding. We'd love that to come from industry partners. We'd love to come from corporate sponsorships. We'd love to, find a way to, get in some of these economic development grants that are available, things that we could partner with UW or OSU on together. Let's see here. I think once we raise a little bit, all of us have full-time jobs. I don't think any of us are in a position to kind of own this outright, but we need to hire some executive talent to actually continue to shepherd all of these initiatives along. We definitely want to solidify and firmly establish our founding executive board. Right now, again, there's kind of 3-4 of us that are really bullish on this idea. But we want more involvement. We want senior strategic leaders in the region to sign up and be a part of nurturing that strategic direction. We want to develop some key subcommittees, actually bring all of you guys into, leadership roles within the org, figure out what parts you can own and continue to move along. And then we want to continue to engage with our other alliance partners across the country. USARC has been created, again, the U.S. Alliance Robotics Clusters. They're starting to really engage in conversations at a government level on a lot of, policy and advocacy issues that are impacting how corporations spend on R&D, reshoring activities for manufacturing in the U.S. And so it's important that our group, be a part of those conversations as well. So anyway, to wrap things up, thank you again. This has been a great first year for us. We've done a lot. You guys have been a big part of that. And so thank you for continuing to show up. Thank you for continuing to show passion for, doing this. I mean, the whole reason we're here is because we believe this region has something unique to offer. And all of the reasons these alliances exist is because we all want to continue to be a part of accelerating the development, the commercialization, the scaling of robotics technologies. And again, I think selfishly, the Northwest has, one of the best regions in the world to be able to do that. And so, yeah, we're well on our way. So anyway, thank you all. Let's go have some drinks.